Hey everyone, welcome back to the channel where we break down the latest trends in the stock market world to keep you informed and ahead of the game. Today, we're diving into why small cap stocks might be on the verge of explosive growth in the coming years, thanks to some unexpected United States president shifts. If you're curious about how recent events in Washington could shape your portfolio, stick around. According to Tom Lee, head of research at Fundstrat, the next few years could bring incredible gains to small-cap stocks, with potential growth of over 100%. Now, you might be wondering why small caps, and why now? Well, it's all tied to Donald Trump's recent return to the political spotlight. Trump's pro-business stance, including a more relaxed regulatory environment and possible tax cuts, is leading many investors to bet big on smaller companies with high growth potential. So far this year, small-cap stocks have been doing quite well. The Russell 2000, an index that tracks small-cap companies, has already jumped 18%. Even with this run-up, Tom Lee says these stocks are still trading at a pretty low valuation, around 10 times forward earnings, compared to the S&P 500, which trades at 17 times forward earnings. This lower valuation could mean that these small companies have room to grow. Lee, who previously predicted the small-cap Russell 2000 index could rally as much as 40% before the end of the year, also said he sees big gains ahead for other assets lumped into the Trump trade. But let's break down exactly why small caps are set to benefit so much from Trump's policies. First, there's the promise of fewer regulations. Trump has been known for slashing regulations to make it easier for businesses to operate, which can be especially helpful for small companies with limited resources for legal and compliance expenses. Second, there's the potential for corporate tax cuts. These smaller companies would feel the impact of lower taxes much more directly than larger corporations. Now, these predictions aren't without risks. One big concern is inflation. A majority of economists predict Trump's policies could drive up inflation, which, in turn, might push the Federal Reserve to keep interest rates higher for longer. Higher interest rates can make it more expensive for companies to borrow money to grow their businesses, which can be a setback, especially for small caps that often rely on debt for expansion. Let's break down the potential advantages and drawbacks of this trend for investors. Regulatory relief can reduce costs for small businesses. Tax cuts may lead to higher earnings, and growth potential is high due to lower valuation compared to larger companies. Drawbacks of this trend for investors might be inflation risks could erode gains if prices rise too quickly, and higher interest rates may make financing expensive, limiting growth for small businesses. So, what does this mean for you as an investor? Well, if you're considering jumping into small caps, you might want to start by looking at companies and sectors that could benefit most from Trump's policies, like industrials, financial services, or tech. Keep in mind that while small-cap stocks can be high-growth opportunities, they're also more volatile and can fluctuate significantly in response to market and policy changes. Here are a few strategies to consider. 1. Diversify. Don't put all your money into small caps. Balance with larger, more stable companies. 2. Research sectors. Focus on industries expected to benefit from lower taxes and fewer regulations. 3. Stay informed. Keep an eye on interest rates and inflation news, as these could impact the long-term growth of your investments. If you found this breakdown helpful, don't forget to hit that subscribe button for more market insights and analysis. And let me know in the comments, do you think small caps will soar in Trump's term, or are you skeptical of the risks? Also, check out our other videos to stay ahead of the latest trends in both stock and crypto markets. Until next time, invest smart.